UVA Community Credit Union is a member-owned, not-for-profit financial cooperative that has proudly served Central Virginia since 1954. Our primary mission is to promote financial wellness and focus on people, not profits, by supporting the needs of our members and investing in the communities we call home. Learn more at uvacreditunion.org. Welcome to our Raising Money Smart Kids series. This video will cover tools and resources designed to help you teach core financial topics to teens 15 and up. Teaching high school students about finances is especially important because it equips them with essential life skills that help them make informed decisions about money as they transition into adulthood. It helps them learn the basics of budgeting, saving, investing, and managing debt. And these are all crucial for long-term financial health. And developing a sound understanding can also help students avoid common pitfalls like accumulating high interest debt or making impulsive purchases. It also helps teens become more self-sufficient, enabling them to handle their, earnings from a part-time job, future living expenses, or even student loans. So there's a lot to focus on at this age. So in addition to building on the previous topics discussed earlier, we're going to add credit, retirement planning, taxes, and insurance. This is also a great age to help them learn by doing. Like hands-on is always good to help you learn. So at this age, when they're often starting to receive their own money from summer jobs, babysitting, or after school work, this is a great opportunity to help them open their own checking account, and if they don't have one, savings account. If possible, you want to look for student-friendly accounts that may not have full adult features. Maybe the limits are a little bit lower, or they don't have certain online access, like sending money through Zelle. Whatever you're looking for, just compare that carefully at different financial institutions to find the right fit. We at UVA Community Credit Union, we have a Teen Rise checking account that has no minimum balance requirement, but you do have debit card and online access. So if you're interested, I encourage you to visit our website to check for membership requirements and to learn more about the Teen Rise account. Once they have their own account, be sure to discuss and reinforce the importance of like keeping their eye on their money, monitoring that account activity frequently, looking for anything that they don't recognize. That can be warning signs of identity theft or just errors. You want to talk to them about if they do see something that they don't recognize, that they should report it to their financial institution immediately, help them through that process, remind them to never share their personal identification number. Keeping their debit card in a secure location is also very important. And using the debit card safely is another topic you want to hit on. Talk to them about how to spot skimming devices before they pull their card out to check their surroundings, covering the keypad when they're putting in their PIN, and shopping with trusted merchants online and in person. Explain potential penalties if they are not keeping track of their money, such as overdraft or even theft. And reinforce the importance of creating a safety net to protect against overdrafts, like tying your checking to your savings account or creating an account cushion to not let your balance drop below that point. You'll also want to help them set up alerts and notifications. So if a balance does drop below a certain point, they may get a text alert so they can move some money around or come up with plan B. At this age, they're also using online payment apps like Venmo or Cash App. Coach them on the dangers of keeping too much money in these accounts. They're more susceptible to hacking and fraud and not as secure as keeping your money in your financial institution. Keep up to date on the most recent scams. There are so many on these that target these apps. For example, one pretty common scam is receiving an unexpected payment from someone who then asks you to send it back because they made a mistake, right? Oh, I accidentally sent you $100. Can you send that back to me? No, never send money back. Often the sender has used a stolen credit card to send that money. And the credit card company, once it's reported stolen, they're going to pull that money back. But if you've sent the money to the scammer, they've often drained their account and they're gone. So you would often be on the hook for that money. So that's a pretty common tactic that they use. Again, just awareness can help protect against fraud and scams. You also want to reinforce the need to protect your online information, right? Explain like just like you'd never leave your phone sitting on a bench unlocked. You don't want to post too much information online, like birthdays, school locations, etc. They're just giving away too much critical information. Oversharing makes it easier for someone to figure out passwords, answer security questions, or even pretend to be you. It's the core of identity theft, and it can actually happen to teens, sadly. So remind them to not share their passwords, even with friends, and to use strong, unique passwords and tools like two-factor authentication. Remind them when they're picking those passwords, it needs to be 15 characters or more often. On their phones, they always want to make sure that their devices are password protected. You want to make sure that you're using a deadbolt, not just a flimsy lock to protect your key devices and information. This is also a great time to just sit down and check privacy settings together on apps and social media. You want your privacy settings, uh, to talk about it, but I always have mine to my friends only, not friends of friends, because, your friends could have some sketchy friends and you don't necessarily want them to have your information. You also want to disable the geo tracking on your device, the camera on your device. It automatically defaults to tagging and sharing your location. So when they post their photo, people can see exactly where it was taken. And that's information that someone could use to unfortunately do some pretty bad stuff. You also want to begin to explain the importance of insurance to teens. Like, try to relate it to something that they care about, use real life examples. So, for example, their car, if they have one, their health, other assets. So they don't suffer a catastrophic loss if they have a fender bender and the other driver is injured. Talk about what is a deductible, but keep it simple. Using that car example, just keep explaining that if they have an accident that results in $2,000 worth of repair costs, but they have car insurance policy with the $500 deductible, the insurance company would only cover $1,500 of the repair bill. Explain that higher deductibles often mean lower monthly payments, but you'll pay more if something happens. And outline the concept of liability, legal responsibility based on who was at fault or responsible for the accident, and how that comes to play in terms of payment. This is also a great time to reinforce the important role that credit can play in their future. Using resources found at myfico.com, you can explore how FICO scores are calculated, what determines a good credit score, and more. Even for teens under 18, it can be a good idea to check their credit report to catch ID theft and fraud early. Unfortunately, child ID theft is a big problem. So, catching that as soon as possible will help you correct errors and report identity theft as soon as possible, which is critical. You don't want to be in a situation where, and unfortunately, I've seen this, where someone's applying for a loan as a young adult and they find out that they've had identity theft on their credit file for years, because it can take some time to clear up and you don't want to be in a last minute situation. So visit Equifax, Experian, and TransUnion for details on how to obtain a copy of your minor child's credit report. And you want to do that on each website, Equifax, Experian, and TransUnion, because not every creditor reports on every bureau. So the information across bureaus, you need all three to get a complete picture. Now, when they're ready to, you know, get their own credit card or start to build credit, help them if you can. For example, credit cards often report authorized signers to credit bureaus. If you have a strong payment history, this can be a good way to help your teen piggyback on that to start building their own credit. That's a gray area. Not every credit card company does that, so you have to check with those providers for details. When they're 18 and they have their first job, you can help them build credit using credit builder credit cards or student credit cards. Some require cash as collateral, some may have hidden fees. So it's important to compare them carefully before committing to one. And reinforce the importance of only using what you can pay back monthly and the high cost of carrying debt. These are important lessons that they should learn before they enter adulthood. We're also going to revisit the importance of investing as a tool to outpace inflation. So review, you talked previously about what a stock is, but now you're going to introduce the concept of bonds, where stocks are ownerships, bonds are debt. You're going to introduce mutual funds and other investment vehicles like cryptocurrency, digging a little deeper into the message of diversification by spreading your investment over not only different stocks, but different types of investment. By allocating assets across varying investment categories, you may be able to hedge against major losses as assets in different classes react differently to market environment. Investor.gov has some great resources that can help you guide these discussions and dig into, crypto and how blockchain works and asset allocation and the risk versus reward curve. So I encourage you to visit investor.gov for a little bit more complex stock advice or education. So piggybacking on the investment discussion, when you're teaching your teen or young adult about managing money, IRAs, individual retirement accounts, are one of the most powerful tools you can introduce because they are tax advantage savings plans. So you have that tax break for using them to save for retirement. And starting young gives you that time value that makes such a big difference. So kind of explain that. Start with the big picture, why early savings matters. Try to make it relatable to them. So say something like, imagine you invest $3,000 a year starting at age 18 and stop at 28. If that money grows at just 7% a year, you could have over 400,000 by the time you're 65, even if you never put in another dollar. This is because of compound interest, which is earning money on your money over time. So the earlier you start, the more time your money has to earn more money, right? So that's the concept that we want to kind of lay down there. It's a good time to introduce the key benefits of the Roth and traditional IRAs. So, with the Roth IRAs, you pay taxes on money now, but when you take it out in retirement, it's tax-free. So again, that tax advantage. Traditional IRAs, you may get a tax deduction now. So you'll pay taxes when you take the money out later. Mention employer-based retirement plans like 401ks, 403bs, etc. Especially talk about the concept of matching contribution, which is basically free money if they're putting in to their employer sponsored plan once they have a job. And remind them that an IRA isn't just a bucket that you put money in. It's a place to invest the money in things like stocks, mutual funds, bonds. That's where the real growth happens. And explain that the IRAs offer tax advantages, but as a trade-off, of course, there are rules. It's savings for retirement. So if you take money out before the age of 59 and a half, you could face an early withdrawal penalty. Plus, be liable for the taxes on the amount that you're withdrawing. I mean, there are obviously exceptions to this, but early withdrawals usually cost more than they're worth. It's, meant to be, it's not a piggy bank, right? It's not a bank account. It's a vault saving for your future. When they have their first real job, help them complete their W-4, talk to them about how to read their paycheck, deductions and reductions that they might see, such as, taxes, FICA, Social Security, and other typical withholdings. Even though they're not taken out, you want to reinforce that medical coverage, 401k contributions, all that would be reflected on their paycheck. And if they aren't earning a lot of money and will not be required to file a tax return, consider completing the W-4 with exempt underline 4C, so no federal income taxes withheld. Verify their filing requirements first, but something to consider. When they are ready to file taxes, if they have a filing obligation, or if they're expecting money back that was withheld, help them. If you're still planning to claim them as a dependent on your return, be sure they check that box, someone else can claim me. If they miss that step, that could lead to a rejection in your return and big delays in getting that process. So that's a pretty critical point. You just want to make sure that they're doing that before they file their first tax return on their own. A fun activity at this age that you can play kind of to test what they've learned is Visa's Financial Football. It's fun, free, and covers a lot of great topics across the board. And you can set the levels to, easy or advanced. You can have hard questions or easy questions within that, but it's just kind of a fun little game that you can play as a family or they can play on their own. If they answer key financial questions right, their play is advanced and their team can win. So I encourage you to check that out. Just Google Visa's Financial Football and you'll find that available online. And as they look towards the next phase to start to prepare for, what's next, bring what they've learned full circle. See if they can prepare a monthly budget for their new apartment, have them read and compare rental contracts, and of course, reinforce the need for being vigilant and protecting their information and property. Especially when students are first out on their own on college campuses or they get their first apartment, they're adjusting to new living arrangements and they're often less guarded than they should be. They're, still in that bubble of living at home mentality. So really make sure that they are kind of upping their uh, awareness game. And consider investing in a simple laptop lock or portable safe to help them secure school IDs, money, jewelry, and other valuables in their dorm room or in their apartment, especially if they have a lot of people coming in and out. So those are great, kind of tips to help them start down the road to adulting. And additional resources that we highly recommend, the FDIC series, Money Smart for Young People. That has a lot of great core curriculum. The CFPB also has a Money as You Grow series. Again, highly recommend that. Next Gen Personal Finance and MyFICO, great resources to